Ryan is 28 years old. He has been investing since he was 22. Last year, his portfolio hit $45,000. He needed $15,000 to buy a car. So he did what almost everyone does. He sold $15,000 worth of his investments. He transferred the cash and he bought the car. And then his accountant called. The $15,000 Ryan pulled out had grown from $8,000 since he bought it. That $7,000 in growth is called a capital gain. That is the profit your investment made while you held it. And the year's taxes that profit the exact moment you sell. At Ryan's income level, that tax bill came to $1,050. Gone, for doing nothing wrong, for simply trying to access money he had already earned. Meanwhile, just 3 miles away, a man with $5 million in the exact same type of investments needed $150,000 for a property purchase. He did not sell a single share. Instead, he borrowed $150,000 against his portfolio. He paid zero tax. His investments kept growing. And next year, he will do it again. Same system, same tax code, 2 completely different outcomes. This is not a loophole, and it is not illegal. This is the strategy wealthy people have been using for decades, and almost nobody explains it clearly enough for a normal person to understand. Welcome to FinFinance. Nobody ever told Ryan that selling was optional. Nobody told him there was a second door. This channel exists to show you that second door the one wealthy people walk through quietly while everyone else lines up to pay the tax. Subscribe and tap the bell. In a few minutes, you will know exactly how to stop cutting down your orchard and start borrowing against it instead. The capital gains tax rate in America sits at 15% for most middle-income earners. For higher earners, it climbs to 20%. Add the 3.8% net investment income tax on top, and some investors are handing nearly 24% of every single investment gain directly to the IRS the moment they sell. On $100,000 in investment gains, that is $24,000. Gone, the exact moment you click sell. But here is the number that explains everything. According to the most recent Federal Reserve research, the top 1% of American households hold over $44 trillion in total wealth. $44 trillion. And almost none of it is sitting in cash. It is sitting in stocks, real estate, and business equity assets that are growing in value every single year without triggering a single dollar of tax. Why? Because they have never been sold. That is the system. Unrealized gains, which is just the growth in your investment's value before you sell, are never taxed under current U.S. law. You can hold $10 million in stocks that tripled in value. You owe zero tax. Until the moment you sell. And the wealthiest people in America have figured out how to spend that money without ever selling. Picture an apple orchard. You planted it 10 years ago. Every single year, it produces more apples than the year before. The orchard is worth more today than when you planted it, and it will be worth more next year than it is today. Now, someone tells you you need $15,000 in cash. You have 2 choices. Choice 1, you cut down part of the orchard. You get your $15,000 immediately. But the trees you cut down stop producing forever. And you pay a heavy fee to the landowner for every single tree you remove. Choice 2, you use the orchard as collateral. You walk into a bank and say, I own an orchard worth $200,000 and I need $15,000. The bank says yes. They lend you $15,000 against the value of the orchard. You get your cash. The orchard keeps producing. No trees are cut, no fee is paid, and next year, the orchard is worth even more than it was before. That is the exact difference between selling investments and borrowing against them. When you sell, you cut down the tree. When you borrow, you pick the apples and let the tree keep growing. The wealthy figured out a long time ago that the orchard is far more valuable alive than it is sold. And the tax code, whether intentionally or not, rewards everyone who understands this. Here's why almost nobody teaches this to ordinary investors. Financial advisors make money when you buy and sell. Brokerages make money when you buy and sell. Nobody in the traditional investment industry earns a commission when you hold everything and borrow instead. So, the system quietly rewards the behavior that generates fees selling, while the behavior that actually builds wealth holding goes mostly unmentioned. Here is the part most financial videos completely skip, and it is the most important part of this entire video. You have been trained to think of your investments as savings. Money you put aside. Money you can eventually take out when you need it. Sell when you need cash. That framing sounds logical, but it is exactly the framing that costs ordinary investors tens of thousands of dollars over a lifetime. Wealthy investors do not think of their portfolio as savings. They think of it as an engine that runs continuously, produces returns continuously, and grows continuously as long as you never shut it down. Psychologists call this the difference between a finite mindset and an infinite mindset. A finite mindset treats the investment as a destination, something you work toward, and eventually cash in. An infinite mindset treats the investment as infrastructure, something you build once and use to generate resources indefinitely, without ever dismantling it. Ryan sold his investments because he had a finite mindset. He saw $45,000 in his account and thought, that is money I can use. The investor 3 miles away borrowed against $4.5 million because he had an infinite mindset. He saw $4.5 million in his account and thought, that is an engine I can borrow against forever. Same account, same investments. Completely different mental model. And here's what makes this psychological gap so hard to close. Every financial advertisement you have ever seen has reinforced the finite mindset. Save money. Grow money. Cash it out when you are ready. Nobody runs an ad saying, hold everything, borrow against it, and never sell. Why? Because that behavior makes them absolutely no money. Before I show you exactly how the strategy works step by step, be honest with me in the comments. Type a 1 if you have ever sold an investment to access cash and paid capital gains tax without realizing how large it would be. Or type a 2 if you have never heard of borrowing against investments before this video. Drop your number below. Let us run the real numbers on what selling actually costs over a lifetime. Take someone who invests $500 per month from age 25 to age 65. At a 7% average annual return, that portfolio grows to approximately $1.3 million. If that person sells everything at 65, assuming a blended capital gains rate of 20%, the tax bill on the gains is roughly $186,000. $186,000. Gone for doing absolutely nothing except pressing sell. Now compare that to someone who used the same $1.3 million portfolio and borrowed against it instead of selling. They access $80,000 per year in loans against the portfolio at a 5% interest rate. Their annual interest cost is $4,000 per year. Meanwhile, the portfolio keeps growing at 7% per year, generating approximately $91,000 in annual returns. The returns outpace the borrowing cost by $87,000 per year. They access cash. They pay zero capital gains tax. And their portfolio keeps compounding. When they pass away, their heirs inherit the portfolio at its current market value. Under current U.S. tax law, that is called a step-up in basis. Step-up in basis means the cost basis of the investment resets to whatever the market value is on the day of inheritance. If Grandpa bought a stock for $10,000 and it grew to $500,000 and he borrowed against it instead of selling his heirs inherit it at $500,000, they owe zero capital gains on the $490,000 in growth. Zero. That $490,000 in gains, which would have cost $98,000 in capital gains tax if Grandpa had sold during his lifetime, simply disappears. That is not a loophole. That is the law as written. And it has been the law for decades. Here is the strategy broken into 3 simple steps. Step 1, buy assets that appreciate. This is not complicated. Index funds, which are single investments that automatically track hundreds of massive companies like Apple, Amazon, Microsoft, and Google, are the most accessible appreciating assets available to any investor starting from zero. A broad market index fund has historically returned 7 to 10% per year before inflation over long periods. You open one at Fidelity, Charles Schwab, or Vanguard. You set up automatic monthly contributions. And you do not sell. This is the buy step. The entire strategy fails if you never complete this step first. Step 2, borrow against your portfolio when you need cash. Once your portfolio reaches a meaningful size, most brokerages allow borrowing starting at around $25,000 to $50,000 in invested assets. You can access something called a securities-backed line of credit. A securities-backed line of credit is just a loan where your investment portfolio acts as the collateral. Collateral means the asset you are promising to the bank in case you cannot repay. Fidelity calls it a pledged asset line. Charles Schwab calls it a pledged asset line as well. Interactive Brokers calls it a portfolio margin account. The loan is not taxable income. You do not owe capital gains on the borrowed amount. Your investments continue compounding while you spend the loan. You pay only the interest on what you borrow, typically 4 to 6%. For most investors, this interest cost is significantly smaller than the capital gains tax they would have paid by selling. Step 3, hold everything for as long as possible. This is the hardest step psychologically and the simplest mechanically. You do not sell. You borrow when you need cash. You let the portfolio compound. And you repeat the process for decades. Here is exactly what to do this week. Tonight, open your brokerage account at Fidelity, Schwab, or Vanguard if you do not already have one. Set up just one automatic monthly contribution, even $50, even $100. The account matters more than the amount. Then look up whether your current brokerage offers a securities-backed line of credit and what their minimum portfolio size requirement is. That number becomes your next milestone. Not a milestone to cash out, but a milestone to borrow against. Ryan paid $1,050 in tax to access $15,000 from investments he had worked 6 years to build. He did nothing wrong, he just did not know there was another option. Now you do. The wealthy do not sell their orchards, they borrow against them. And they let the trees keep growing for generations. Hit subscribe and tap the bell. Every video on this channel gives you one more move the system never taught you. The next video is already on screen.